In this video, I'm gonna go over VGT and FTEC. So without further ado, let's get into the video. All right, as I said, this is gonna be FTEC versus VGT, a comparison. All right, this is what we're gonna be covering today, overview of VGT and FTEC, and how to actually research both ETFs so you can make an informed decision, all right? And then at the very end, I'll give you some very important considerations. So if you guys are getting value from these videos, please share the video, all right? Let's get more people investing so more people have options in life, all right? Let's remove the gatekeeping and let's break this cycle. All right, quick disclaimer, I'm not a financial planner, financial advisor of any sort. I'm just some dude on YouTube that's sharing his own knowledge. All right, let's get into it. Overview of VGT and FTEC. So FTEC or FTEC is Fidelity's Information Technology ETF. And Fidelity is a great company. All right, I did a lot of investing with them prior to moving on to M1 Finance. Their phone support is really excellent. They have a lot of different, mutual funds, a lot of different ETFs. They also have, S&P 500 index. They have a couple low cost or no cost ETFs, which are very popular. FZROX is one of them, all right? And that one I have a video on from like way long ago. But they're definitely worth a look if you want to open a brokerage account with them. Of course, I'm not sponsored. I'm just sharing my feelings about them. So we also have Vanguard's Information Technology ETF, VGT. And for those of you who don't know who Vanguard is, they're one of the biggest fund managers out there in the world. And they have a lot of different ETFs and mutual funds out there, right? They're very reputable. A lot of their ETFs and funds are probably the cheapest on the market. You probably can't find cheaper than most of their funds. Not all their funds are cheaper, but most of them. All right, and just so you guys know, both of these tickers, VGT and FTEC, they follow an index, right? Similar to like the S&P 500 index. However, this index is called the MSCI Information Technology Index. And there's two flavors of them, which I'll go over here in a second. There's the 2550, which Vanguard follows, and then there's the straight up Information Technology Index, which Fidelity follows. All right, both of these indexes are actually very similar, but we'll get into that here in just a moment. All right, so how to actually research both of these ETFs. So let's open up this web browser. I want to show you guys real quick, and you can Google this. All right, this isn't complex, and I'll show you where I pulled these from. Okay, you have the MSCI Information Technology Index, right? And then you also have the MSCI Information Technology 2550 Index. These are two different indexes, but they're very similar. All right. They give you, some information, just how they've performed over the last couple of years. Just real quick, the MSCI Investable Market Index Information Technology is designed to capture the large and mid-cap, small-cap segments of the U.S. equity universe. All securities in the index are classified in the information technology sector as per the GICS, or the Global Industry Classification Standard. All right, so we know that this Information Technology Index, you can see the performance, you can kind of just get some more information, and then you can see the actual holdings that it has, right? This is their allocation, their weightings, right? It doesn't give you everything, but it gives you, just kind of like, their top 10 holdings, right? You can get a more extensive list through their website, but I'm not going to get into that. So I just wanted to show you guys this, all right? So this is an index that some funds or ETFs will follow, all right? So whenever you see the MSCI Information Technology Index, this is what it is. Like NASDAQ 100, which QQQ follows, they have their own index, okay? So we also have the Information Technology 2550 Index. Again, very similar. All right, it's the same thing. 2550 Index is designed to capture large, mid-cap, and small-cap segments of the U.S. equity universe. All right, so, and then they give you a couple holdings, right? They give you the top 10 holdings. But you can see that these weightings are different from each other. Like if you go down and you actually compare the two, the weightings in Microsoft, the weightings in Apple, and weightings in NVIDIA are far different than the weightings for Microsoft, Apple, and NVIDIA in the 2550 index. So again, they're very similar, but the way they do that, their allocation strategy and their weightings are different. So let's get into the comparisons, because this is what is very important. Whoops, as you guys can probably see, I was doing a little more diving earlier. So anyways, here we go. We got VGT and FTEC on Seeking Alpha. Again, you can sign up for a free account. I'm not being sponsored by them, but what you want to do is go down to the left side, go to comparisons. And I know my screen is somewhere probably down in the right, so hopefully you guys can see this. Let's get rid of this. All right, so let's get into it. I gotta change this. Sorry guys, doing this all on the fly. Price. Okay, cool. All right, so we have VGT. They've been around since 2004, right? So they have a track record. Anything over a decade, you know, you again, when you're selecting funds, you usually want to go things that have a track record. Having a track record of 10 plus years is a good sign, right? Their expense ratio is 10 basis points or 10%. They have $87 billion under assets under management. All right. That means that a lot of investors are piling their cash into VGT, right? Assets under management is how much the fund is managing, how much money the fund is managing, all right? If we look at FTEC, Fidelity's MSCI Information Technology Index, we see it's been around since 2013. Again, that's good. That's not bad. They've been around for a decade. They have a lower expense ratio than Vanguard, and they have $10 billion assets under management. The difference between Fidelity and Vanguard is they're really going head to head, toe to toe with a lot of their ETFs. Fidelity has actually been dropping their expense ratios in order to compete with Vanguard, because Vanguard is legendary in the fact that a lot, if not almost all of their funds are typically lower cost compared to their competitors. So that's what, really put Vanguard on the map. Along with being, Jack Bogle, who is the founder of Vanguard Group, he is known as the father of index, father of the index investing. So again, just a little more information for you guys. Anyways, back to VGT and FTEC. All right, so we know we got this information. All right, so if we look at a price return, again, looks kind of crazy, right? This doesn't tell the whole story. We don't care about the price because it's the share price. We want to know what a price return looks like, right? And again, I'm going to show you guys this as we get through, but it looks like FTEC is actually beating out VGT by a very small percentage, right? Almost under 1%. Now, that may not seem like a big deal, but it could be the difference between $1,000 in return, $100 in return, or maybe $10,000 in return, depending on the size of your portfolio. So over the 1 year, it looks like FTEC has actually been outperforming, which is pretty cool, because both of these are following the same index. But we'll get to that. We'll get to the kind of the surprise at the end. So if we zoom out a bit, 5 years, we see that VGT is still underperforming in price return. Okay, we're talking about price return. Now, if we change the story a bit, because price return is, the share of the price. If it's $100, it goes to 105, right? That's a 5% return. But what we want to know is the total return. This is going to be, capital appreciation of the shares plus dividend growth, if I'm not mistaken. So we actually see it paints a very different story. It still shows that FTEC is still beating out VGT by 1%. Okay, so right now we know that in 5 years, or over the past 5 years, VGT is beat out VGT. I'm sorry, FTEC has beat out VGT. But if we're looking at the graph here, they're almost trading identically, right? Aside from that 1%. Now, this is where it kind of gets interesting. So if you look at both of them, and we look at the 10-year price, VGT has actually outperformed FTEC by a whole whopping 10%. Now again, that may not seem like a lot, but it could be the difference between $100, $1,000, $10,000, or if your portfolio is massive, in the millions, it could be a $10,000 difference, right? It really all depends. But yes, that makes a difference. But again, we want to keep in mind that past performance is not indicative of future returns, meaning that just because it did well in the last 10 years does not mean it'll beat FTEC in the next 10 years, right? So we just want to keep that in the back of our minds. All right, so we did a little bit of research, right? We know that VGT has 323 holdings. We know FTEC has 296 holdings. Now, I want to introduce you guys to another layer of research. All right, so we want to know which one's the best, right? This is why we're here. This is why we're learning. So we're going to go to, and I already did a lot of the research for you guys. So let me just, reset. Okay, cool. So we're going to go to Vanguard's webpage. All right, we're going to actually look at Vanguard's. We're not using Seeking Alpha. We're not going to use Google for this. We're not using Yahoo Finance, none of that. We're going to use Vanguard's actual website. And we know, the expense ratio is 10% or, 0.10%. What else do we know? Down. They've been around since 2004, also good. But what I really want to point you to is the performance. All right, over 10 years, VGT has returned 20.8%. I hope you guys can see that. It has returned 20.8%, 87%, all right, to be more specific. Now, I want to know how FTEC did. Well, Fidelity has a webpage. Again, you can Google this and find it yourself. For you guys watching, I'll put links down below in the description for you to save you some time. If we look at FTEC and we go to performance and load. Okay, so we can see right here over 10 years, and this is on their own website, over 10 years, their NAV has returned 20.64%. So again, that's 0.20% difference, right? Not a massive underperformance, not a huge underperformance by any means, right? But it is an underperformance nonetheless. So we want to just keep that in mind, okay? So now we know from the vendor's own websites who's actually been doing well, right? Now, I want to point you to how you compare these two with their holdings, because one is the Information Technology Index, another one is the 2550 Index. So there's a new, well, not a new tool, but there's a tool out there called ETF, ETFRC.com, ETF Research Center, right? Here you can actually look at ETFs and compare them and look at what overlap exists. Overlap is when two ETFs have the same exact companies, right? But they have different allocations, different weightings to each of these different company or to each of these companies. Okay, so we're going to put in FTEC to compare one, right? And put in VGT to compare another one, right? We're going to hit find overlap. So you guys know this is a live website. It's not some fake thing. So we see that between the two, there's 272 overlapping holdings. That's 98% of FTEC's holdings are actually in VGT, right? And then 91% of VGT's holdings are actually, are in FTEC, right? So they're almost very identical, almost. Now, where it gets interesting is towards the bottom, right? We see FTEC is underweight compared to VGT. Hopefully you guys can see this. They are underweight by about 2.5%, right? Apple Inc., they are underweight by 3.5%, and then you have Broadcom, and then Nvidia. This is the interesting one. Nvidia is super overweight in FTEC than it is in VGT, which explains the reason why FTEC has actually outperformed VGT this year, right? This year, because NVIDIA had such an explosion. So the fund manager probably capitalized on that and went heavier into NVIDIA. Now, you can see it right here. They're extremely overweight versus, FTEC is very overweight in relation to VGT. Again, very interesting. So if we go back to, and this is on their own website. If we go back to FTEC's webpage on Fidelity.com, And if we scroll down, actually, we got to go back to overview. And we scroll down. We want a description of this fund, right? And it says it right here. So this is a long block, but basically what I want to show you is that, Fidelity's FTEC is going to invest into the information technology index, right? Vanguard has one as well, where they tell you they invest into the MSCI index 2550 right here. Where is it? Oh, it's right up here. So yeah, 2550 index, right? So right on the vendor web pages, they tell you exactly what index they're investing in. Okay, so we know that. But here at the end, this is where it explains the NVIDIA outperformance. They invest at least 80% of assets in securities included in the fund's underlying index. That means they're going to copy the index at minimum or at most 80%, right? They're investing most of the money, the fund's money, into 80% of whatever the index is doing, right? So that means that gives them a little more freedom to find these, these NVIDIAs, to find these stocks that are going to pop, or to take advantage of these, other companies, right? So that explains, at least in my mind, why Fidelity was able to outperform VGT on the short term, right? Again, they're beating them by almost a whole percent, right? But that doesn't tell you the whole story, and that is my whole point about this. So that is actually how to research the ETFs. If you guys like this type of content, I got a whole free Skool community. I'll put a link down below in the description. It's other investors. We're all getting together. We're just talking. I have a whole investing masterclass series on that through the classroom. We're going to be having coaching calls, coffee hours, just conversations over Zoom in the future. Link down below in the description. All right, so some very important considerations before you go out and start buying anything, right? This is what you got to think about. Remember, past performance is not indicative of future returns. I have to say that again, all right? Just because something is doing well now and has done well in the past, 10 years, doesn't mean you should just keep buying it and that it'll always do well, right? This is where you have to kind of craft your own, your own thesis, right? I know that the S&P 500 index, based on historical returns since 1928, has returned almost about or in around 8 to 10%, right? Realistically, it's about 10.23% if I recall the last time I looked at it, right? But that's since 1928, right? But there's history, there's historical context to why people should invest into an S&P 500 index. Does it mean it's always going to do well? No. You have the pandemic, you have the great financial crisis that occurred, you have you have the dot-com bubble burst, right? Where, the index dropped, 50, 30, 45%, in all these different scenarios. So it doesn't mean it'll always do well, but over the long term, if you invest over the long term, they typically do very well. All right, so you should always know, keep in the back of your mind that past performance is not indicative of future returns. All right, you always want to research before you buy anything. I can't stress that enough. Always research before anything. There's a lot of YouTubers, a lot of financial influencers, a lot of, whatever out there that tell you, go buy this, go buy that. This is what they're buying, right? But what they don't show you is, one, the actual buys, or two, how they actually came to their conclusion, or three, even how to research how they came to their conclusion. They're basing everything off of share price, and probably share price for the last 5 years, if that, if they even went a step above and actually looked at the share price, right? Please just do your own research before you buy anything. And I just gave you a bunch of ways to do research, okay? I literally gave you kind of the secret formula to doing that. Whenever you buy anything, you have to have a long-term mindset, okay? You have to be an investor. You're not a trader. You're not going to buy one ETF and then trade out of it the next day because some financial influencer or some YouTuber, or you heard some bad news or some good news about this new ETF. So you're going to just pile up. You could be causing yourself a huge headache by doing that. You're going to be paying taxes on capital gains, all right? That's first and foremost. And that's if there's a capital gains event, right? What if you took a loss, right? What if you took a loss on purchasing a VGT and it went down a couple percentage points and now you're down money? You sell out of it only to buy into FTEC which is going down even further, right? Let's say Nvidia just had a really bad month and the share price just went bad, or the bubble popped, right? Or maybe AI is no longer cool. I don't know, right? But again, this is why you have to have a long-term mindset whenever you buy anything, right? You want to think, I like to think decades, right? At least minimum 5 years. I like to think long-term. I'm a long-term investor, all right? So that's all I will say. I hope you guys enjoyed this video. Again, if you're getting value from this, let me know down below in the comment section. Like, subscribe, all that other good stuff. I'll see you guys in the next video. Peace.